Good morning, Clubhouse. Good morning, the Creative Birth Strategies podcast. Joe Scarice, co-founder, co-host of the Creative Birth Strategies House and podcast, brought to you every Sunday morning, 9 a.m. Eastern Standard Time, providing education, strategy, and networking. So let's get rocking and rolling here in a few minutes. Our discussion today is real estate markets showing caution on leverage, DSCR, and rehab construction loans. So we'll get started here in a few minutes. I'm going to invite some people in and get rocking and rolling in just a few minutes here. Get up here. So I brought Dave up here, Big Dave. Make a moderator. There you go, Dave. You got moderator status. Look at that, man. Just getting started here in just a few minutes. Was not feeling too well yesterday, so I had to kind of like take a little rest for the day. So slept it all off and ready to rock and roll today. And we'll get inviting some people in. We're going to have a great discussion. Also give your views of the week, of my looking at what the market bared. Pretty interesting week this past week. We just invite some people in, so we get started here in just a few minutes. But in the interim, I want to thank, obviously, Mr. Gerald Perkins, who really provides all this social media backup. We have all our podcasts up to date as of today. So you're going to see 150 plus podcasts on the website at creativebirthstrategies.com as of today. Pretty excited about that. So we're up to date. We're also going to be working on going live on LinkedIn at the same time as Facebook and YouTube. And then we load it up to Spotify and Audible and all that good stuff through Buzzsprout. But we're working on that. So we'll be live on LinkedIn hopefully in the next week or two. But right now we're currently live in about 300 Facebook investor groups, YouTube, and then we go live with everything else. So let's get started with the market, of course. Rates kind of leveled off, man. They went down below 6%. 30-year fix is at 5.99 coupon rate. On the commercial side, it's 5.75. So from a DSCR perspective, you're somewhere between 6 and 6.5 on cash out up to 75% loan to value. You could technically go up to 85% loan to value on purchase and be in the mid sixes. This is a unprecedented time for the real estate investors, probably in the last 2 to 3 years. With a very sluggish market for the consumer, this is going to be an excellent time to identify B neighborhoods for rentals coming up. But yet there's going to be caution in the market. So let's go over some articles that caught my eye this past week. Let's see here. Nearly 1/3 of Americans hope for a housing market crash. That was a very interesting article. I did post that up this week. For many Americans, the prospect of becoming homeowners has become so unattainable that some are even hoping for a housing market collapse so they can afford to purchase a home in today's economy. That's arguably the most significant and depressing findings amongst the Americans that were surveyed in the housing market. That was a very interesting article. Let me see if any other articles caught my eye that would be precedented toward what we're talking about here today. Obviously landlords are still facing major insurance issues. And in a lot of states, the insurance is just skyrocketing, which is throwing a lot of the numbers off. When I used to just estimate, hey, the rent, the insurance for $1,000 for a single family home, it's no longer the case. It's usually now $1,200, $1,300. So very interesting perspective there. That's throwing DSCR off a little bit. But those are two articles that caught my eye today over the past week. My thoughts to the market this week, market sentiment and transaction dynamics. There's a lot of home selling frustration spikes. Can't sell house or higher now than during the 2008 housing crisis, signaling widespread seller resistance and longer days on the market as buyers stay on the sidelines and supply-demand imbalance. Inventories, investor stories and strategies. Young investors are scaling with Burr still. A lot of investors are looking at their rental portfolio and just scaling. They're looking at light to medium rehab, and they're just refinancing and holding over and over again. And then obviously there's some policy and regulation that came into place with FinCEN. I mean, to me, it's more of just a couple of additional paperwork between the title and the legal department. Now they consider non-QM lending as a cash purchase, which I don't know if that really business lending, it doesn't make a heck of a lot of sense, but for them to create more paperwork, I guess that would justify. There's a rental shift where rental markets are seeing higher vacancy, and anticipated rent, and I see a lot of days on the market on rentals too. So that B market, B plus market is having some issues, as well as affordable housing markets with the vouchers. I see it in Philadelphia. I see it in St. Louis, Chicago. I see it up in the Connecticut market, Bridgeport area, which is a big Section 8 blend of B neighborhoods. But I'm seeing days on the market increasing. Let's see here if we catch anything else. Investor takeaways this week: cash flow strategies still resonate. Burr and rental arbitrage remain attractive for individual investors. Regulation matters. Capital markets, let me see here. See if I can catch my eye. I mean, overall, rates came down. I see an increase in DSCR. I see an increase on real estate investors coming off the sidelines, identifying rehabs, more to hold than to flip. I'm seeing also the attempted creativity of some people, some investors, in trying to wiggle their way through deals. Credit is still key. You need to be 680 credit score or better, really, on average. 660 is pretty questionable, but 680 is going to be your key factor and above for DSCR and fix to flip, fix to rent. Experience level is always going to be key. Knowing how many deals have you done in the last 3 years, right? Meaning, how many completed projects have you done in the last 3 years, whether it's a flip or a rehab? And that's very important to a lender, because we're going to verify that. It's going to be very important for us to justify leverage, which we're going to talk about today, and it's going to talk about rate. So when it comes to work being completed, meaning flips or rehabs completed in the last 3 years, that will justify whether I come up to 95% on purchase, 100% on construction, and 75% loan to value on the after repair value. If you don't have that higher level of experience, I might cut back a little bit between 85 and 90%. Why? Because I have a concern that you're not going to complete the project, and I'm going to have to take that project back. Now, though I don't want to take that project back, I want to make sure that I'm leaving myself cushion, that you have a little more money into the deal initially. On the DSCR side, getting up to 75% cash out, you need to have, your credit needs to be there. All right. It needs to be a 700 and above, typically. 680 could be, on the edge. They're also offering an 85% loan to value on a purchase, but the DSCR has got to meet 1.2 or better. And you got to have a 700 plus credit score. So that's going to be important too, as well. So a lot of the DSCR and the rehab loans kind of work together, but they work separate. One doesn't work on experience as much as one or the other. So like DSCR, I don't care how much experience you have. I care about the DSCR of the project. I care about your credit score. I care about the asset type. I care about the loan amount, the leverage. On the rehab, I care about the experience in the last 3 years. I care about the credit score. I care about the project itself, the complexity of the rehab. Is it a low to medium rehab? Is it a heavy rehab? Are you adding square footage? These are showing caution to lenders today, more so than ever before. There's a lot of foreclosures right now going on based on poor underwriting done by a lot of these lenders. So the lenders that are in the space right now that want to deploy money, they want to be a little more cautious, because they don't want to be part of the bigger picture of what's happening in the market. So we'll get started with our moderators today, of course. Always thank them every Sunday morning. They come in, they're very dedicated, providing their insight. And most of the time, these guys are not even knowing what the subject is. They're kind of coming in cold in the sense of the discussion itself. So we'll start off with Mr. Dave Bergio. Good morning and welcome. Brief overview, who you are, what you do, and thoughts to real estate markets showing caution on leverage, DSCR, and rehab construction loans.
Hey, Joe. Good morning, everybody. Dave Bergio, founder, owner of Trifecta Credit Solutions. Been out of town, helping people, help operate their
You know what, State? I decided I'm not going to have a white label course in March because I just need a little breather, and I'm going to focus on the one we're having in April at Lehigh Valley. Plus, you and I have an event this month coming up in March with Nancy O'Brien with Jumpstart Lehigh Valley, and then I'm speaking at Garrett Rhodes' event the next day. So there's only so much my brain could facilitate before leaking. So I'm cutting back on the in-person events that I hold for myself, as we decided, where I need to be out at other people's events, which has made a lot more sense. Since kind of like clipping the association with the Sub Two guys, and they were great guys, but it really didn't make a lot of money or a lot of sense for me to run those events with them, collaborating with them. It's just I'd rather be out on the street meeting a lot more people. Like this week, I got to meet almost 150 people just going to other people's events. Just the cost benefit relationship made way more sense. Now we still will have the second Saturday of the month podcast interviews like with Dave Bergio and a couple other great real estate professionals, and every Sunday morning. And we'll do a white label course here and there, and we'll do a specialty type of gig here or there. But I'm going to be more on the street meeting with real estate professionals and investors on a day-to-day basis. And to continue with my thoughts with what Dave had to say on market showing caution on leverage, the real estate market isn't tightening, it's normalizing. For the past few years, leverage was easy, spreads were compressed, assumptions were optimistic, exit timelines were aggressive. Many investors underwrote appreciation instead of cash flow. Now, capital markets are recalibrating. With DSCR loans, lenders are scrutinizing true rent sustainability, vacancy sensitivity, insurance and tax volatility, borrower liquidity and reserve strength. And then on rehab and construction loans, caution is even more pronounced. Conservative Rs, tightening of the LTC limits, more disciplined draw processes, clearer exit strategies. This is not a negative signal, it's a structural reset. Leverage is still available, but it must be earned through math, not momentum. Investors who underwrite conservatively, build margins of safety, stress test rents and timelines, engineer exits and acquisition will continue to scale. Those who relied on loose underwriting and thin liquidity will feel friction. Capital today is asking better questions, and that's healthy. Structure beats rate, discipline beats speed, execution beats emotion. 2026 belongs to the operators who understand the leverage is a tool, not a strategy. Good morning, Bob. Welcome. Brief overview who you are, what you do, and thoughts to real estate markets showing caution on leverage, DSCR, and rehab construction loans.
Right now.
longest real estate professional friends in the business. So it was good to have him here, sticking around with this. He was ahead of the game with the caricature picture, by the way, everybody. I think he beat everybody out with this greenish picture of him. Everybody was doing these caricatures for a couple months on Facebook. But Bob, you're always ahead of the game. I got to give you credit. You're gonna say any response to that? Well, is that where they have the dart section, or no? Is that a separate area? Is that where the dart section is, or no? The dart? I think Bob makes some interesting points. Cash flow is everything. Everybody's so wrapped up in the rate. Worry about your cash flow. Yeah, the rates are pretty good right now. Okay. And with a direct lender, your rates are going to be very good. You're not going to pay origination fee. You're not going to do a soft pull. They're not going to do a hard pull. It's going to be a soft pull. So you'll know the difference whether you're working with a broker or somebody that's corresponding the money right away today. If they're charging you origination, they're not a direct lender. That's just a fact. Okay. So we don't charge origination. I show you the yield spread of either buying the rate down to the betterment for yourself to make yourself feel better, warm and fuzzy, or you could buy the rate at par where there's no origination. There's a standard underwriting fee. There's a standard legal fee. You close it, but okay, great. You got a great rate, but what's your cash flow? Are you making $300 a door, $500 a door, $800 a door? Like, what are you making per door, no matter what the rate is? What if the rate was 8% today? You have to take these cautions into perspective, not just for the short term, but from a cash flow perspective and a long term. And what are you recapturing? And then what's the game plan with the property? You're going to own it for the next 10 years, 30 years, whatever. Like, you need to know what that looks like because one, there's tax repercussions, there's depreciation, okay, on the DSCR, and then not all rehabs that you think are going to flip are going to. I know so many flippers that are now holding properties and making very small margins because they miscalculated the market. Key market realities right now, right? Higher, their interest rates are a little different, not higher. Right? I think they're settling out, but it's a tighter financing, slower rental growth than recent years, rising operating expenses. Nobody's taking into account all these operating expenses, and a shift in tenant demand, value, flexibility, and amenities. So the question becomes, how do you realign your strategy so cash flow, risk control, leverage, and exit optionality improve, not worsen in the market? You have to reposition your asset strategy. A short term flexible rentals where feasible, right? If you own and travel secondary markets, convert units to short-term rental or hybrid leases. Maybe target corporate travelers or relocations or extended stay guests using dynamic pricing instead of static rents. Why this works? Because traditional long-term rents, plateau. Flexible pricing can capture a variable demand. Maybe multifamily conversions, maybe like a triplex that had a commercial storefront that's empty. Maybe look at trying to get the town to allow you to convert it to residential. Because I'm telling you right now, mixed use, that 2 or 3 unit apartment building with the 1 unit storefront, terrible pricing right now. The only options you can go to is a full documented credit union or bank. I mean, otherwise, you're going to come to an asset-based lender such as myself. If we have the program, it's somewhere between 9 and 10% on the rate. Why would you want to pay that kind of money for that type of building? It doesn't make sense to me. And what if the commercial unit goes empty? And a lot of these, how many pot shops and nail salons can you have? So it's all about the operating expenses. It's all about how are you going to rent that unit? And then ADUs are really starting to pop up. I'm seeing a lot more ADUs coming into place. Often easier financing and permits are easier there. The tenant demographics are really good. They're students or remote workers or aging parents. I think ADUs diversify income while preserving existing cash flow. And there's a shift in resilient niches right now, rent to own or lease options. This offers tenants options to purchase later, generates a higher monthly rent. It attracts a longer term tenant with skin in the game, hedges against future price growth. Lease options are also reduce vacancy risk. I think there's a niche demographics out there for senior assisted living transitions, military families, remote workers desiring good internet and workspace, tailored amenities, desks, lighting, storage, command premium rents. Obviously, there's a lot of other exit strategies that you want to look at, when you're rehabbing these properties. But I think at the end of the day, low to medium rehabs right now are going to be the top priority for the investor in 26, not the heavy gut to the studs. This is going to allow me to feel less concerned about your leverage with or without higher or mid-size experience. Felix, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion. Real estate markets showing caution on leverage, DSCR, and rehab construction loans.
See,
Always putting it together with Felix, a framework, right? Cash flow. Will the increase net rent or reduce revacancy? Risk. Does it make cash flow more predictable? Leverage. Can I finance this cheaply and sustainably? Operations. Can I manage it efficiently? Exit optionality. Can I sell or refinance easily later? If the answer leans yes to most, the pivot is worth exploring. Now, some other pivots you want to keep in mind by investor type, converting maybe a duplex with an ADU, adding an ADU maybe above the garage, remember the Fonzie garage from Happy Days, lease option strategy, short-term rental focus, the small multifamily owner, increase unit count via conversion, shift to subsidized tenants, or outsource professional management. Portfolio builder, maybe more Section 8 specialization, maybe some syndications or joint ventures. Using DSCR to financing to scale. Most of my DSCR refinancers are staying around 70%. They're not maxing out. They know the rate is not complementary. They know that their cash flow is going to get eaten up by a higher over leveraging. But at sometimes the cash flow is so good, it might as well take the other 5%, whatever the rate might fall. Because at the end of the day, if you're going to take you got to remember in commercial lending, there's a 5, 4, 3, 2, 1 standard prepay. You can do 4, 3, 2, 1, 3, 2, 1, 2, 1, 1, no prepay. But obviously the best rates are at the 5, 4, 3, 2, 1. So you got to take that in consideration when you're looking at the rate. Now remember, you could pay down on the balance. You just can't pay more than 20% a year without penalty or refinance. So again, if you're getting a rate at 6% or 6.25% right now, what are the odds are you really grabbing 5.5 in the next 3 years? I don't know if it's going to, 5 or 5.5. I don't know if it's going to be there. Will it even be cost benefit? What if the values are not there? What if your values decrease if the rates go down? So you got to look at the science behind this, where you might not be able to capture that much lower rate if your value might not be there when the time comes. Hold on one second here. Just looking at something here. But that's when I get concerned when people get wrapped up in leverage and DSCR and the rehab. So that's some concerns I have with my overall thoughts from what Felix had to say. Linda, good morning and welcome. Brief overview, who you are, what you do, and thoughts to real estate markets showing caution on leverage, DSCR, and rehab construction loans.
Good morning, Joseph. Good morning, everyone. My name is Linda Plivagas. I'm the owner of Realty411.com. We help investors on their journey with real estate investing. Definitely want to proceed with caution when doing flips, especially right now in California. We're seeing properties staying on the market a lot longer. They're averaging 70 days on the market, especially higher end properties. I guess you could call them maybe real estate. They are definitely sitting on the market much, much longer than before. Some of them are not selling at all. Be very cautious. I've also seen properties in the lower range, starting entry level properties that would be me, uh, properties sitting on the market, which tells me the local rehabbers are not getting involved. Either they're not interested in purchasing those properties at that price. They may be, overpriced. They're not able to buy them at a discounted rate and provide the value needed if we sell them on the market.
They looking to buy elsewhere? Or are they still trying to pull it off in California? Where are most of your investors looking?
Oh, yes, a lot of them are going out of state. They're still going out of state. And and I pretty much started Realty411.com 18 years ago. In fact, that's why I started Realty411, because there were so many investors that were going out of state, and a lot of them were getting money. They weren't dealing with ethical people, ethical property managers. They were buying properties that were way overpriced. And I kept seeing that happen. So I wanted to create, a forum and a network to really try and help educate people about the benefits, but also the pitfalls behind long distance. Because it's a different caveat.
Yeah. See, with the non-QM lending, it's made landlording out of state so much, I think, easier to build your team elsewhere, where people are confident that they can be out of state landlords. Where years ago, I think the only options you had were the credit unions and local banks, and if you weren't within an hour of your properties, they wouldn't lend to you. You know what I mean?
Yes. And I just think there's so many more resources available now for out-of-state investors, including real estate groups. You have a lot more forums online about out-of-state investing, and if things aren't going right, you can either try and get help. You can also do a lot more research about existing property management teams, existing um, key providers. You can actually do more research about them and see, are they doing what they say they're doing? Are customers happy? Do they have any complaints online? So I just think there's so many more resources that are making it easy to buy. It's pretty.
I think the real estate structure risk. The era of easy appreciation and loose underwriting is behind us. The market, I think, rewards discipline, liquidity, and engineer exits. So that's my mindset shift. I don't know what you're seeing I mean, it sounds like you're seeing that at your events. Do you have anything coming up that we need to be aware of?
Thank you so much for asking. We do have our national real estate conference March 28th in Los Angeles. We're up to about 200 people registered so far. We're really excited. We have a variety of education, including fixing or flipping, buying out of state. And the best thing is that people can actually meet the turnkey providers, the educators in person. I just think that makes such a big people. That's why we continue to have these events, and most of them are complimentary. Have a very low.
Sounds great. Leverage is a tool, not a trophy. In low rate cycles, leverage magnifies gains. In today's environment, debt costs more, refinances are not automatic, rent growth is normalizing, liquidity matters more than ego. The mindset of 2026 is using leverage to control downside first, upside second. Ask yourself, if rent drops 10%, am I still safe? If rates stay elevated for the next 24 months, can I hold? If exit cap rates expand, do I still have liquidity equity? If the answer is no, you're speculating, not investing. Structure beats rate now more than ever. A 6.75 well-structured loan can outperform a 5.99 poorly structured one. What matters in 26? Interest only versus amortization strategy. So I offer a 10-year interest only with a 30-year amortization loan that adjusts on the back end of 10 years. An average investor does something with their loan every 7 years. So you have 10 years to figure out what you want to do. You're not paying down debt, but you're cash flowing a lot stronger. There's more prepayment flexibility with non-QM lenders than ever before, like we just briefly discussed. Cash reserves are always going to be key. Realistic debt service, not pro forma optimism, right? You would want it to be 1.5, but maybe it's really 1.2, 1.3. More of a conservative R of assumptions. Underwrite like a credit committee. Stress test rents, stress test cap rates. Model refinance at today's rate, not hope. Leverage must align with exit. Liquidity is leverage. In volatile markets, cash is strategic leverage. Small investors lose not because deals are bad, they lose because they run out of liquidity. 2026 discipline: maintain 6 to 12 months reserves per property. Avoid max LTV stacking. Leave margin for CapEx surprises. Protect operating runway. Liquidity gives you negotiating power, holding power, opportunity power. Control risk before scaling. The temptation that rates will drop, I'll refi later. The disciplined approach is I'll buy only if the deal works at today's cost of capital. This means buying at discounts, targeting stronger DSCR, avoiding thin margin rehabs, passing on deals that only work in perfection. Remember, growth without durability is fragility. Intelligent leverage strategies in 26. Stabilized rentals, conservative, LTV between 65 and 70%. Strong debt service cushion is 1.25 minimum. Aim higher. Fixed or hybrid structures with flexibility. Your rehab value adds, budget for overages like 10 to 15% contingency. I always take a 10% contingency in whatever rehab number you give me. Short duration holds. Define exit before closing. Avoid refinance dependency. Ground up construction is specifically strong equity stack. I always suggest owning the land and having a shovel ready. When you're buying the land with me, you're going to have more into the deal. When you're buying, you own the land already and you have it shovel ready, I'm reimbursing you more on the deal. Phase draws tightly controlled and conservative sell through assumptions. The 2026 investor identity shift, the old mindset, I can leverage 80 to 85% scale fast. The new mindset, I can leverage intelligently and survive cycles. The winners in 2026 will think in portfolio risk, not property excitement. Engineer exits before acquisition, protect cash flow margins, value durability over speed. And some thoughts here, leverage magnifies everything. Discipline over recklessness, structure over sloppiness, strategy over speculation. In 26, leverage must serve control, stability, and engineer growth, not ego, not pace, not hype. Going back to Dave Bergio, some final thoughts on real estate markets, showing caution on leverage, DSCR, and rehab construction loans.
That is final thoughts, that draw for.
Well, you got an event this week on Wednesday, right? 11:30.
Yeah, I do.
Yep, I'll be there.
Yeah, I'll be speaking.
Absolutely. So thanks for your follow-up on this. And Bob, your final thoughts to real estate markets showing caution on leverage, DSCR, and rehab construction loans.
I think basically my final thoughts, investing again, not legal advice. It's currently.
Let's, the banks and the credit unions don't want to do what the type of loans that I'm talking about today. So I just want to make sure you understand the separation of credit unions and banks. They want nothing to do with a DSCR loan, nothing to do with a rehab construction loan. If they have anything to do with a DSCR loan, they're brokering the loan. They're not a direct to the loan itself. Okay, you need to learn about who is really a direct lender, who is a correspondent, and who is a broker. Right? A direct lender doesn't charge origination. A correspondent charges origination, along with maybe the rate might be a little more inflated than typically a direct lender because they're taking money from the direct lender. And then you have the broker that's outright just taking a broker fee. You need to know the difference. Okay, so that's very clear because at the end of the day, volume and costs run side by side. Felix, some final thoughts to real estate markets showing caution on leverage, DSCR, and rehab construction loans.
This is
Final thoughts to real estate marketing showing real estate the markets with leveraging DSCR and rehab construction loans.
Wonderful advice, Felix. You took a lot of the advice I was going to mention. Yeah, you can tip, Felix.
Thank you. Final thoughts to this discussion, and we tackle. We're not like any of the other clubhouse rooms. I can tell you that for a fact. We're very specific in our attentions in subject matter, and we're very we pick a lane. Okay, we're a no sellathon type of environment where there's no gimmicks. We're not selling any workshops or anything of that nature. We're just providing pure content because this is a podcast as well. I think we're the only clubhouse room that has their own podcast, their own website. 150 plus episodes, 2 years of existence, 15,000 downloads, some crazy number like that. It's doing quite well from a small perspective, and we're going to advance it even more as we go live on LinkedIn, hopefully in the next week or two, along with Facebook and YouTube, and then going to Buzzsprout where it hits all the social media sites. So, when we're talking about these events and what's going on in the market, we're peeling it right off the current agenda, right? In 26, leverage isn't disappearing. It's being repriced and re-underwritten. We're seeing a clear shift Lenders are tightening around DSCR coverage strength and liquidity reserves and construction draw oversight and realistic exit assumptions. The era of aggressive pro forma optimism is fading. Today's capital rewards discipline, not projection. For DSCR investors, the ones that are listening in, that means strong in place cash flow beats speculative rent growth. Sensible LTVs outperform max leverage. Liquidity and experience matters more than ever. For rehab and ground up operators, conservative ROs win approvals. Tight scopes and realistic timelines reduce friction. Contingency planning is optional. It's underwriting. Isn't optional. It's underwriting. The market isn't saying don't invest. It's saying engineer the deal correctly. As always, structure beats rate. Underwrite like a lender. Build with margin. Exit with intention. In cautious markets, disciplined operators just don't survive. They gain market share. So, it says underwrite like a lender. We offer underwriting courses every single month. We're taking off in March, coming back in April with Dave in Lehigh Valley. Then we'll be back in Philly in May. But I enjoy teaching the underwriting courses. I get about 10, 20 people in the room, and it's great because we get a lot of really great content covered. I hope when people walk away, they learn something. I hope it doesn't give them an unrealistic expectation on lending. Sometimes it does, and you have to ask somebody, would you lend to that individual based on the scenario that you're providing to me? Yes or no? Does it make sense? Does it sound shady? Is there something wrong with that, what you're explaining to me? Think about it through, right? If you're explaining it to me and I think it's weird, explain it back to yourself. Put the shoe on the other foot. As a real estate professional, you can't make something that doesn't make sense, right? So you got to really think through what is a deal. And the problem is everybody thinks everything is a deal. Not everything is a deal. You can't jam a square peg in a round hole. I swear to you, you can't. I've tried it multiple times. In life, you can't. So, some also thoughts to what's going on in the current market, current events, obviously this past weekend with U.S., going into Iran. I think you're going to see some very inflationary pressure. I think you're going to see some uncertainty, slow, but buying decisions. You're going to see people a little more cautious over the next couple of weeks, watching how this all settles out in the Middle East. Very interesting. It all happened over the weekend, so we'll see how the market reacts on Monday. I think you're going to see investor behavioral strategic shifts with liquidity and becoming a little more bigger picture. Not a crash, but maybe a repricing and reprioritization of the market. We're already seeing this happen. We're seeing values stagnant, inventory stagnant. No new inventory to grab onto for the buyer, the consumer. The consumer waiting on the sidelines. They'd rather be a tenant than an owner. I mean, this is not a room to talk about first-time home buying. If you're in this room, you're in the incorrect room. This is for an investor mindset, an investor directive. And I'm going to tell you, this is a very interesting time for the investor to go into the Class B market than ever before. You could go into a market and outbid someone at 80 to 85% LTV purchase on a commercial business loan. And I'm telling you, the listing agent's going to look at that a lot heavier than an FHA 3.5 or 5% down product being presented to them for the same price. Fact. For a fact. Because they know that commercial business loan is going to close quicker. There's going to be a lot less hair in the deal. The appraisal just has to meet the numbers. And they know the market rents are going to sustain that property. So the smarter investor mindset, again, we go back, prepare for macro volatility, but anchor in long-term real estate fundamentals. Real estate isn't disconnected from global events, but it rarely fails purely due to external war-related stocks. So, keep an eye on what's going on in the Middle East. I don't think it's going to have as much impact as you think in the investor space. So I want to thank our moderators. Of course, they've been fantastic in providing their personal insight and thoughts to this discussion. And I don't make these discussions easy. we want to tackle discussions that hopefully hit at home for you. And we definitely want to separate ourselves. For us to be on Clubhouse, we want to separate ourselves from any of the other Clubhouse groups and rooms because we want to tackle very specific subjects. It's not going to be like a big open net discussion ever. So I want to thank these guys. I know all these people that are moderators personally. I've met every single one of them. They're fantastic human beings. Great to know every one of them. You should be grabbing a one-on-one with every single one of these guys. Bob, he just left, but Dave and Felix and Linda, you should be grabbing a one-on-one with these guys. I mean, why wouldn't you? I mean, they're giving their time to provide. And then why haven't you reached out to Yardell to talk about social media or myself, man? Let's do a one-on-one video podcast. I know you're not in my area, but we could set something up. Got Big Dave coming in March. Felix, I need to get you up and running with me on a podcast sometime soon. Same with you with Linda. But yeah, I mean, we're providing education, networking, and strategy every week, every Sunday morning, and then every second Saturday we're doing one-on-ones. We're in 300 plus Facebook groups when we're broadcasting live on YouTube, soon to be live on LinkedIn. And I really appreciate the time today with the discussion. And my quote today, and we're going to cut it a little early just because it's just how it falls sometimes. Sometimes we go 60 minutes, sometimes we don't. My quote today is, dream a dream so big it scares you. Go beyond comfort, reach for the stars. Not for applause, but for perspective. Build structure, stay disciplined, execute relentlessly. The view at the top isn't success, it's clarity. Think bigger, move smarter, climb higher. Everybody have a blessed week. Have a great week. Reach out to some of you met here on Clubhouse or on our podcast. Say hello, just check in with them. And we'll be ending the room in the next 30 seconds. And have a blessed Sunday. Thank you.
Everybody enjoy your weekend and enjoy the rest of your